Good afternoon, ladies and gents. I am Cecil Lourens. I'm the head options strategist at Your Options Forecast. Many traders have asked us about synthetic options, whether we can explain the concept. A synthetic option is a method to indirectly set up a position that you're after without actually purchasing the position. Let's say, for example, that you're interested in a long call option. So a synthetic option would be saying, how can I get a long call without actually investing in a long call? And the immediate question is, why would you want to do that? Why not just buy the call? Why want to set up it in an indirect method? Let me discuss this in two parts. In this first part, I'll just show you how it works and discuss why it works. And in the second part, I'll then show you why you would like to do something like that using a trading example. So let's move to the wheat contract. Yes, February wheat 8 days. Let's search for a contract slightly longer time to expiry. Here's the March contract, 36 days to expiry. So let's analyze this option. Do not worry about the market, the direction it's going. We're just using this as an example. Let's say that you are interested in a strike price of 570. Let's say that you, for some reason, you want to buy a put option at a strike price of 570. You want a 570 strike put option, but you want to achieve that without actually buying the put option. It sounds funny. So let me just show you. This is a put 570. Let's analyze that put. A put 570 will cost you $875 US. So if you were to long this put option, that's a situation that you will end up with. Remember that the put option is something that you purchase when you expect the market to go down. You've got a limited loss. So if the market moves up, I'll show you here, if the market moves up, you're having a loss of $875 US. If the market goes down, you've got an unlimited profit, and that's a put option that you're after. But we want to achieve the situation without actually buying a put option. So let me show you how to do that. Let's just clear this. So instead, let's reset the call options. So we go to a strike price, same strike price, 570 strike call option. Analyze that. That option trades at the price of $637 US. So we're going to pay $637 US to purchase a long call 570. So let's long that call. And then let's take the futures and we went short the futures at the current market price. And there you go. So here you can see you've got exactly the same position as the long put would have given you. Look at that. 875 is the maximum loss you can take in this position here. If the price moves up, you take a loss of 875. If the market goes down, you've got an unlimited profit. That is exactly the same as the long put we had a moment ago. However, we don't have a long put. We've got a combination. We've got a long call, that long call at the strike price of 570, and we've got the short futures at the current market price of 565.25. And this combination gives us exactly the same result as when we went long the put. Why does this work? Well, if you look at the individual positions that we've got here, if the market should move up, remember now we want the market to move down. If the market moves up, what do we have? Well, we're losing on the long futures. So we short the futures. If the market moves up, we are in trouble in the futures. We're going to lose money on the futures. However, that only applies up to a price of 570. If the market moves up higher than 570, I've got a call option at 570, and I can just exercise this call option at 570. And if I exercise the call option at 570, I will receive a long futures at 570, and the long futures will cancel out the short futures. So I'm out of the futures position. Let's do the calculation there. So I went short the futures at the price of 565.25. I then went long the futures at 570. That's a loss of 4.75 points. On wheat, the point value is $50, and let's multiply that by 50. So I'm facing a loss of $237.50 on my short futures. And that's up to 570. Above 570, I exercise the call option. I'm out of the futures. I'm out of trouble. I'm taking a loss of $237 on the futures position. But I've also bought the call option. So minus 637 is what I paid for the call option, and I'm at $875 loss. That is exactly the same price as what I would have paid for the put option in the first place. So we see that the combination long call option, short futures gives me exactly the same loss if market should move upwards as if I just outright purchase a long put option. So it's exactly the same thing, and if the market goes down, of course, then my futures kicks in. I've got unlimited profit on the futures, and that combination is then what's giving you that final situation. So market moves up, I'm losing $875. Market moves down, I have unlimited profit. That is the put option that I originally had. However, I set up a put option without actually investing into the put option itself. Okay, so that is how you set it up, and by just calculating the profit loss in both directions, you can see how it works. The important thing that you have to do, you have to work out in your own mind for yourself, what combination of options and futures do I need to invest in to recreate the actual position that I'm interested in. Shown on screen. If you want to pause the video here, you can do that. Here's a guideline as to how to set this up. So if you're interested in a long call option, you can achieve that by longing a put option and then longing the futures. And for each of these combinations, just do yourself a favor. Take a calculator and calculate for you the profit loss if the market should move up using the combination, and if the market should move down using the combination. And then using the same calculation method, market up, market down, calculate for yourself what will happen in the regional position. And then work out for yourself that whether you use the combination or whether you use the original position, they are exactly the same thing. They're giving exactly the same result. That's the important thing that you're after, and you need to make that part of your trading arsenal. Be aware of these combinations, and that these combinations can actually give you the same result as the original position that we've had here. Okay, look out for part 2 of the video. In that part, I'll discuss to you why you would want to set up something like this. Just as a closing note, this is an incredibly powerful method of trading. Make it part of your arsenal, be aware of it, and use it in your own trading. Okay, thank you for watching.